Let's Talk Money.
Welcome back. You're with us on this week's edition of Let's Talk Money, and we're talking about going global with our investments, that is, and the different options that you have. And our experts have, reached the agreement that it's much better to look at global equity markets through Indian mutual funds rather than trying to do it on a piecemeal basis individually by trying and buying international stocks sitting here in India because of the various charges and the complexities involved. So, Chintan, now let's come down to the issues at hand. The limits that you spoke of, the fact that a lot of global funds, Indian funds that invest in global markets, they're simply not taking money.
Yes.
What is this limit issue?
So I think almost all are shut right now because there was originally a limit of $7 billion for funds which are investing outside.
$7 billion.
$7 billion, which funds which are investing outside, that's about 60,000 crores. And there's a separate limit for $1 billion if you're investing in ETFs outside. I think that's the basic limits. And those limits were set 15 years or so back because obviously India has to conserve its foreign exchange reserves as well, and there was a quota that are there. We hope that these limits eventually open up, and when rupee appreciates and as we become a $8-10 trillion economy, definitely this should open up. Hopefully, before we become an $8-10 trillion economy, it will open up. But currently, these limits are regulatory limits, and hence most of the mutual funds which were accepting money earlier are shut for subscription right now for investors to invest outside.
So when you talk about the whole universe of global funds which are operating here in India, are most of them fund-of-fund structures that simply go and invest in other funds or ETFs, international funds or ETFs? There's something called the feeder fund route. And are there any Indian asset managers who are actually buying and choosing stocks directly, global stocks directly? Do we also have those kind of funds?
Yes, so we have all the options. So typically, as far as US is concerned, for example, we have a fund which invests outside. So we pick and choose based on our research. Then there are funds which are investing in funds outside as well. So that's the feeder fund of fund, wherein someone else, some other asset management fund company is managing the fund, and we are just basically feeding into that fund.
Okay.
So both options are available, and then there are passive funds as well. So these are active side.
Correct.
And then on the passive side, you basically invest in a index fund outside or an ETF outside, or you have a fund here which is mimicking an index.
Like the NASDAQ. We have a lot of products on the
where
NASDAQ.
we basically are actually, like our NASDAQ index fund is actually picking the stocks of the NASDAQ and investing in those stocks outside.
Sure.
So it's not a feeder.
So and I've always wondered, from an investor standpoint, what would be, in an ideal world, when these funds were accepting money, what would be the best combination or the best route? I mean, it's very easy to understand. If you're bullish on US technology, you'll go and take a passive product,
Yes.
a NASDAQ-based ETF product. But what else? I mean, how should you look at your investments?
So currently, as we look at it, there are different options available. For country-specific also are available, like Hang Seng and Nikkei, and China also. US, of course, is the predominant one because it forms 60% of the global market cap. But as far as investors is concerned, much like how you choose sectors, because sectors are cyclical, even countries have cycles, right? Japan from 1990 to 2019 was probably not doing much. And from 2019 to 2024 recovered most of the pain that it was there. And similarly, other countries have ups and downs. So as far as investors are concerned, I think they'll do well to not, follow the past performance, because that generally leads to investors investing in a late cycle where they then get hurt. And we saw that happen in Brazil, for example. Brazil for the last 4-5 years has not done much. But before that, it had moved, like I said, 100%. Similarly, maybe even US tech, etc., which, like Mohit bhai mentioned, has done very well for the last 15 years. But that's not necessary that it may do well in the future, because valuations also catch up. So as far as investors are concerned, that's where we felt that, having a fund of fund, which is taking bits and pieces or an allocation to all of these available funds is something which would be fruitful for investors, where we are making the choice and they are not. And that's where there's one more option available as and when they open. That's called the Global Advantage Fund of Fund. That's essentially a fund which we are running, where we are allocating to these international funds based on our research. So that investors don't have to make the choice. We are making it easier for them.
Okay. All right. Fair enough. So that kind of explains the choices that we have. Now, Mohit, let's talk China, because I know that you're actually a little optimistic on this market. And, like Chintan is saying that past performance is no guarantee of future returns. He cited Brazil's example. But I know that you're still willing to take a bullish call on China. The market's yo-yoing. It's going everywhere. But if you do want a part of the China equity action, then what route would you follow? What kind of funds would you invest in?
So there are three ways to my mind from the mutual fund route, and there are a couple of other options on the ETF side. The three quick ones on the mutual fund side are Edelweiss Greater China Fund. It's actually a JP Morgan fund managed by JP Morgan, which gives you exposure to all three: China, Taiwan, and Hong Kong. Markets. To my mind, this is one of the best options to invest, right? The second one is Axis Greater China Fund, which is again a good option to invest in. And the third one, which is not exactly China, is a Mirai Hang Seng Tech ETF FOF, right? So it's just tech on the Hang Seng index, but not pure play China. So the first two ones are the pure play China funds, which are available to Indian investors through a mutual fund route.
Okay, fair enough. So those are some options that people can work with in case they're really convinced on the China call. But gentlemen, we also have to now talk about currency, which plays a huge part, because unlike, investing here locally, where we just have to bother about how good a company is, how efficient a stock is, in international investing, we have to look at currency appreciation or depreciation very, very carefully. So Chintan, what are the tips here? And again, I say, because you'd want the market to give you 10% return, and then you have to account for all kinds of currency risk. So what are the factors that one needs to keep in mind?
So, Surabhi, when you're looking at investing internationally, of course, the dollar return matters to us. And let's take the example of Japan to make it easier for investors. Japan, for example, may have gone up 100%. But the Japanese currency has depreciated by about 30% in the last, say, 2 years or so. In that case, the return is 70% and not 100, right? So you need to take care of currency. In the case of India, for example, you invested in US 10 years back when rupee dollar was, say, 55, and today rupee dollar is 84. So not only the return that you got from the US investments doing well, the currency depreciation also has added to your returns.
For a foreign investor who chose India.
For an Indian investor who is investing abroad. So for, say, Indian investors who invested, let's say, in US 10 years back, and US, along with India, has been the best performing market globally. So whatever return you got, add the currency return, because rupee depreciation from 55 to 84 in the last 10, 12 years has added to your return over and above what US markets gave. So dollar returns have been good. And then if you convert it into rupee, it adds to your returns.
So would it be, right to say in a simple fashion that if you're thinking of investing overseas, try and invest in a market where the home currency is going to be a very strong currency vis-a-vis the Indian rupee? Would that be a...
So rupee depreciation helps you when you are, or rupee coming down from, say, 80 to 84, helps you when you're investing outside. But if rupee goes from 84 to 80, and mind you, that could be the case if India is going to become the stronger part and world's third largest economy, there is, much like we've seen in Japan from 1970 to 1990 and China from 1995 to 2015. Now it's said that 2013-14 to 2034 is India's 2 decades. Rupee may actually have an appreciative bias also. So for those investing outside, rupee going up from 84 to 80 may reduce your international investing returns if rupee is going to appreciate. You need to keep that in mind if you are a believer that rupee may appreciate.
Wow. So there's a lot of volatility beyond just the stock movement that you have to consider on the currency front as well. But, what are the average returns? If we talk about a longer time horizon, at least 5 to 10 years, then with all of this currency fluctuation volatility, typically China, I mean, what is the return that these funds have generated in the past? Again, only for reference, not to project them in the future. But Mohit, let's talk China and the US, because these are the 2 key markets, right?
The first choice or first door of reckoning for anyone would be a US market. And my sense is, I think a US market typically would be in the similar range as an Indian market. Plus, as Chintan bhai mentioned, if you are in the camp which believes that rupee will continue to depreciate against the dollar, last 20-year trajectory of rupee has been 3.5% depreciation, annualized depreciation against the dollar. So if that were to continue, then it would add on to your underlying returns. But if rupee were to appreciate, obviously you have to take that off from the table. But my sense is 12 to 15% should be your range of expectation if you're going primarily in the US market. And then otherwise, if you're going in any other market, it's very difficult to predict, because the underlying volatility of each market could be fairly high.
You're going to China, Mohit. Mohit, you're going to China. So what is your return expectation, say, over the next 3 years?
My sense is I'm expecting a higher double-digit kind of return from the Chinese markets, given the cheap valuations at which it is quoting. And my bet is that the government and the central bank out there is pushing a lot for the economy to come back on track. And all said and done, a $19 trillion GDP economy, which is a global growth engine, commodity guzzler, will have to swing back into action for the global growth to pick up.
Sure. Okay. Well, we're almost out of time, Chintan. So final thoughts. And we haven't touched on one wonderful silver lining, which is taxation, right?
Yes.
Because after this budget, the July 24 budget, taxation on global funds, international funds has become very, very favorable. Now, I think the definition of long term is only 24 months. You hold for 24 months and the tax is 12.5%. So does that apply to even funds, whether you're investing in Japan, China, Greater China?
Yes. So the July budget beautifully clarified and removed any confusion whatsoever. Any international fund of fund or index fund or fund of fund that you're investing, for example, outside, if you're holding for more than 2 years, it will classify for long-term capital gains tax and the 12.5% bracket. If it is for less than 2 years, much like any other fund of fund, it will be taxed at 20%, which is a short-term capital gains tax. So this has been the tax clarity has also made it more, let's say, good for the investors to get into the international funds as and when they open, and we hope the limits are opened soon so that the investors can take advantage. Having said that, just to add, I know limitation of time, US markets and Indian markets valuations-wise are same. Indian growth rate is 6-7%. US markets is only about 1.5-2% real growth. So one is probably decelerating, the other is accelerating. So I still believe that the large investors or the large investment money being in India is good. There will be tactical plays internationally, but I think India is where the next decade is.
Okay, well, we like the sound of that. And as you said, from a tactical point of view, to add a little bit of color to the portfolio, if you want to go to US or Japan or China, now you know the options. Gentlemen, thank you very much. This has been a helpful conversation. Thanks for joining in and answering all of those queries. Well, with that, it's a wrap on this edition of Let's Talk Money. Do keep sending us your comments, feedback, questions. We'll see you again next week.
Let's Talk Money